Hi, I'm Seth Freudberg. I'm the Director of Options Trading here at SMB Capital in Manhattan. I'm also the head trader of SMB's Options Trading Desk. So welcome to the options video for this week. And I'd like to recap that last week we were talking about the covered call and what I thought was the glaring weaknesses of the covered call in most cases in the way that most people trade those covered calls. So I'm here today, by the way, in SMB's conference room. We've got the great Anne-Marie Band here, who's been on the Options Drive many, many times. We've got the great Shan Shan, who is in charge of the options trading contest. You live or die based on Shan Shan's read of your spreadsheet. But in seriousness, this is fun. We have a little bit of a group with us today. Anne-Marie's up in New York shooting a video series for us. So in any event, I promised everyone that we would talk about the right way to trade covered calls this week, and so that's what this presentation is about. So just to recap, people love to trade covered calls, especially if they own equity portfolios. They see covered calls as a way of providing extra income on top of the dividend income that they received, as well as hopefully the appreciation on their equity portfolio. Last week I talked about what I saw as the weaknesses of the covered call strategy, which are many, and I'll just reiterate those. The covered call caps your upside. That's what a lot of people forget about. And so if you have a stock that you've correctly determined a bullish play on, and then it does exactly what you think it will do, there's an end to that, and you have basically inflicted that upon yourself. So that is one weakness of a covered call. The second weakness is it barely reduces your downside risk. Yes, it does reduce the cost basis of your shares, but not by that much, and I don't think it really meaningfully reduces the downside on a covered call strategy. And finally, something that a lot of people miss, they'll get talked into doing covered calls on stocks where they have serious embedded capital gains prior to the covered call program. If their shares get called away, they're going to take a big capital gain as a result of that. A lot of people don't think about that, and it can get ugly. So, however, I do think there is a legitimate use of covered calls, but I think the conditions have to be right, and I want to talk about those conditions for a minute. First of all, a covered call is a bullish play. Don't get confused about that. It is a bullish strategy. You're bullish on the stock. That's the only reason you would do a covered call. You're not going to do a covered call on a stock you think is going to go down so that you can make money on the call while getting killed on the stock. It is a bullish strategy. So number one, you've got to be bullish. Number two, and this is key, you've got to have a price target. If you have a price target and you are not looking for a grand slam home run, you feel very comfortable taking the trade off once you've hit your price target, then that is a case for a covered call. If you feel there's a potential for a massive increase in price, you should not do a covered call. It's going to cap your gain. If you're that bullish, you should not cap your gain by putting a covered call on. And if you're wrong and the stock does sell off, if you're wrong, if you were bullish, if you had a price target, then the covered call does help a little bit in terms of the situation, and so it's a positive. And finally, and this is a point that I think is very important, if you're right and you have a price target and you had predetermined you were going to get out of the trade at your price target because you feel that is the end of the run, then the covered call actually enforces your discipline. So it becomes a way of essentially enforcing trading discipline. So I think that's legitimate. Let's just take a very, very simple example from recent times. On April Fool's Day, April 1st, the SPYs had sold off to the 205 area. It kept bouncing off that area, and I'm sure there were a lot of traders out there noticing that and thinking maybe it's time to get long the market. And so if you were to, on that day, have said, I'm willing to get long the SPY, the SPY seems to be having trouble getting past 212, so that's going to be my price target. And I'm going to consider this basically your support resistance play. When I get to resistance, I'm going to be very, very happy to get out of the trade, and that will be the end of that. And so that's your price target. 212, you get in at 205, and And let's think about the value of that short call in this particular case. We bought, as you can see, we bought 500 shares and we sold the 212 call. So if you do the math, we've gotten $580 of extra income out of the trade. If the SPY sells off, if we're wrong, we've reduced our loss by that $580 minus whatever you may want to pay for closing that covered call, closing the call. If you do ultimately sell the shares, you have to close that call so you're not naked. But you will get some benefit from having sold that covered call. And remember, you were bullish in the first place, so you were simply wrong if that occurs, in which case the covered call has benefited you in your bullish play. And finally, if the market does rally to that 212 level, it forces you to accept that trading discipline because your shares are going to get called. So as of today, the position's up nicely, as you can see. This is a hypothetical position. I didn't actually put this on, just did this for demonstration purposes. But had you done a very logical thing, gotten long the SPYs at 205, and you sold that covered call, this is exactly where you'd be up over 2,000 bucks. So covered calls can be valid. But again, I want to review under what circumstances. When you have a legitimate long opinion on a stock. When you have a price target that you're willing to honor. And often missed, when you close your eyes and you see that capital gains tax that you're going to have to pay on the long shares, you can live with that. And I can't emphasize that enough for investors who have decided to get into a covered call program. You have to think about the tax consequences of this before you enter into it. And if you're fully ready to pay that capital gains tax because you think those shares are fully valued, great. Take your capital gain and move on to the next opportunity. If you're going to wince when you pay that tax, don't get into covered call programs. You're going to find it to be a mistake. So that's my talk today on covered calls. That's what I think is a legitimate use of them. I think it can be a very nice addition to your income if you are a disciplined trader. So thanks, and we'll see you next week.